It's time now for the big picture. Let's welcome in the team from Charles Schwab. As always, Collin Martin, Director and Fixed Income Strategist, Schwab Center for Financial Research. Michelle Gibley, Director of International Research at Charles Schwab. Michelle, let's just start off with you and just sort of switch gears to another sort of international story that we've been tracking, and that is, of course, the new Prime Minister, the first female in Japan's history. Just give us a sense of what this means for the market, given the price action that we've been tracking there with dollar-yen and also, you know, the equities catching a bid off the back of that and sort of what's been dubbed the Takaichi trade. Why is this important for us to sort of be keeping tabs on right now?
I think that, we get a lot of attention to Japan's government debt levels because it is high, but we don't hear actually a lot about Japanese stocks. They're up double that of the S&P 500 this year. And, the JGB market has been volatile, and there's questions about whether Takaichi will pursue excessive fiscal spending. That's what she campaigned on. She has since moderated her view on the amount of fiscal spending and dovish monetary policy. But we could get more volatility as the details of her policies become known. The Bank of Japan meets later this month. They're likely on hold, awaiting for more visibility about fiscal policy. But Japanese stocks are up because profit margins are expanding and valuations are still attractive despite the gains so far this year. We're seeing reforms to improve corporate governance, which is increasing stock buybacks, increasing transparency, and reducing cross-shareholdings. And we're seeing a spike in M&A activity as activists are pushing management teams into value-enhancing activities. If we get more volatility surrounding the Bank of Japan meeting or the ideas about fiscal spending, it could actually be an opportunity to get into Japanese stocks.
Right, and obviously moving inversely to Japanese yen, which has been sort of on the back foot because of this, and obviously that's why we've seen the sort of yen carry trade conversation coming back very much to the minds of investors. Just want to stick with the international theme before we switch gears to Collin and just get your thoughts on the latest US and China tensions. Obviously, we've heard from Jamison Greer this morning talking about how him and Bessent are off to Asia now. They're going to be trying to hopefully lay some groundwork for a potential Xi-Trump meeting, but then Trump sort of saying, well, maybe not, I don't know. So, I mean, how have you been looking at this story and, the market reaction off the back of this and, how significant would a meeting be?
Yeah, I think both sides are really looking for leverage ahead of that potential meeting between Trump and Xi. And, the thing is that having a relationship is mutually beneficial. So a deal is more likely than not longer term. We could get some bumps along the road, and China has taken this bold position to use its rare earths as leverage, and because in part they've been able to find new markets for exports, and it dominates the supply of rare earths. But the rest of the world is not happy about China's threat to restrict rare earths, so it may need to moderate its position. Trump is actually indicating a willingness to negotiate. Despite this 100% tariff on Chinese goods recently, he also said that would not be sustainable. And even if we look even broader out, he's talking about potentially reducing the rate on Indian goods to 15 to 16% if they stop buying Russian oil. And so I think this is just negotiation. And the name of the game is negotiation at this point, I think.
It certainly is, and we'll be keeping tabs on what happens next. I think trust seems to be the big issue here. But Collin, let's just get to you and switch gears to what we're seeing as far as some of the action today. You say that the drop in the 10-year yield to sub 4%, which is something that we saw last week and it's continued to hover below that level, is noteworthy, particularly in light of a data desert that we've been in. What do you make of that?
Yeah, that's the tricky part. It's noteworthy because there's not necessarily anything driving the moves lower in Treasury yields. We're in this data void right now because if we compare the stock market to, say, the Treasury markets are much more driven by the economic data versus how earnings reports are looking, and we're knee deep in the earnings season right now. We just haven't had much data to change the view, yet we've seen this kind of downward trajectory of not just long-term yields, but short-term yields as well. The two-year Treasury, under 3.5%. despite not much changing from a Federal Reserve outlook. Markets are still expecting a cut next week and then another cut by December. But I think it's noteworthy because we're not sure the 10-year Treasury yield should fall much further from here. We have inflation that is still too high. We'll get an updated inflation report on Friday when the CPI is finally released, albeit about a week and a half late, to give us a more fresh reading of what's going on there. But prior to the shutdown, most indicators suggested that inflation was near 3% or so, and the labor market, while slowing, wasn't necessarily falling off a cliff. So we think that the sticky inflation, we think fiscal concerns, and we think some of the global developments. Michelle touched on Japan, but we see trends in global bond yields moving a little higher. That might put some sort of a floor below long-term Treasury yield. So even as the Fed is expected to cut, we think long-term Treasury yield, specifically the 10-year, is probably going to hold around 4% and not fall much further from here.
Okay, and you're saying that even with a potential for an inflation surprise come this Friday, I just also want to get your thoughts, obviously, on some of the credit concerns that had creeped back into the market late last week. It looks like we've largely moved past that, but everybody's waiting for the next so-called, as Diamond coined it, the cockroaches. I'm just wondering how you're sort of assessing the market reaction to that and, whether you see this as sort of isolated or sort of a little bit more systemic.
It's probably somewhere in between. We hear a lot of people talking about the idiosyncratic nature of this. And I think it was Goldman CEO Solomon mentioned that these appear to be idiosyncratic. But if you look deeper into the data, defaults have been happening for the past handful of years now. We got these big kind of headline grabbing ones over the past few weeks. But we look at default data from Moody's and Standard & Poor's. They track what's going on in the market, and the default rate's been elevated for about 2 years now. And we just haven't really been hearing about them because a lot of those defaults are distressed exchanges as opposed to Chapter 7 or Chapter 11 bankruptcy filings. So they're not really making their way into the headlines just yet. We're not sure. We don't think it's necessarily systemic. We don't think we're going to see a huge surge in defaults. But I think what's important in an environment where the default rate is elevated a bit, it's not as high as it's been in previous recessions, but it's up from the past few years. What is the compensation that investors are earning given that risk? And as you mentioned, markets are basically shrugging this off right now. Credit spreads, or the extra yield you earn when lending to high yield issuers, remain very, very low right now, which shows the markets don't really care too much. That's somewhat of a warning sign for us. We think it makes sense to take risks if you're being compensated well, but that's just not really the case right now.
Yeah, and look, as Liz Ann Saunders also says, don't look for the next cockroach. Look at the balance sheets of some of these companies as well. So I thought that was a really important takeaway too. Collin Martin, always a pleasure. Thank you, Michelle Gibley, as well. That is Collin, the Director of Fixed Income Strategist at Schwab Center for Financial Research, and Michelle, Director of International Research at Charles Schwab.